Pillow talks taxes. He has been for over 45 years, and there isn't a human on the planet with more experience solving problems on behalf of taxpayers. He wants to solve your problem, whether you know you have one or not. So if you do have a tax problem, get a hold of him, call his office, visit his website. If you don't have a tax problem, your current tax problem is taxes themselves. So let's get into the policy issue of today. The main one being Senator Ron Wyden has decided that billionaires need to pay their fair share. So the statement seems to think that working Americans like nurses and firefighters pay taxes out of every paycheck, but billionaires do not.
Well, of course, that's fundamentally absurd. In fact, I would suggest to you, Josh, that every aspect of this billionaire's income tax is absurd. Wyden makes the statement, if Congress passes this law, billionaires, where he uses the word, will finally pay their fair share, as if they haven't been paying any income taxes all along. What makes that absurd, Josh, is it is universally recognized based on IRS statistics of income data. Anybody can look this up, go to the IRS's website, go to their Freedom of Information Act page, and you can get statistics of income data right off that website. Anybody can look at the data. Anybody can read the data. Anybody can write articles based on the data. We see this happening all the time, and the IRS's data supports the fact that the top 1% of income earners pay just 40% of all income taxes. I believe the number is 40.4%. Almost 41% of all income taxes are paid by the top 1% of income earners. To say that these people are not paying their fair share and are getting away with not paying taxes when firefighters and secretaries are paying taxes out of their paycheck, fundamentally absurd, and it's demonstrably false. And the problem is they say this stuff so often, nobody in the legacy media challenges them on it, even though the data is so readily available. It seems like I'm the lone voice out there that's challenging the comments that millionaires and billionaires don't pay their fair share of income taxes. In chapter 3 of my book, Dan Pilla's Small Business Tax Guide, I lay out in great detail all elements of the federal income tax code that ensures high income people pay more taxes, not just dollar amount, but percentage more taxes than lower income people. Guaranteed, billionaires are paying more taxes than secretaries and firefighters. We got a graduated income tax system. And the more income you earn, the higher, not only the more tax you pay, but the higher percentage of tax you pay on the income that you do. That's what a graduated tax system is. So it's not enough to just increase the dollar load. They have to increase the percentage load as well. And so for Wyden to say that billionaires are avoiding income taxes on their lawful income, whereas firefighters and secretaries have to pay on their income, it's just a lie. It's an absolute lie. When you parse this bill, you see exactly where he's coming from with this stuff and why it is such a fraud.
It seems to me that they're just banking on nobody actually doing any research on the data, and they can just lie and make people envious in order to raise taxes instead of focusing on the fact that taxes are too high for everyone across the board.
Yeah, that's exactly right. That's precisely what they're doing. If you look at the summary issued by Wyden's office on this bill, he says right in there, don't worry about this because it's only going to apply to less than 1,000 people in the country. And this is another one of the absurdities about this bill. There's only between 900 and 1,000 billionaires out there in the United States to begin with. Now, when we use the word billionaire, Josh, we're not talking about people that make $1 billion a year in income. We're talking about net worth, right? The difference between the fair market value of your assets and the debts that you have incurred. When you do that simple math problem, the product of that math problem is net worth. People that have more than $1 billion worth of net worth are considered billionaires. There's less than 1,000 of them in the United States. That doesn't mean they're earning $1 billion a year in income. They might be making more than $100 million a year in income. In fact, that's how Biden parses this out. He says it only applies to those making more than $100 million a year with more than $1 billion worth of assets. So this is extremely high income people. It's just a tiny sliver of the top 1% of the wealth in America. Here's where we see the fraud.
They love to say that billionaires pay no income taxes. They usually frame it as if they aren't paying any income taxes, ignoring the fact that most taxes, especially sales taxes, property taxes, and the myriad of other taxes that we're subjected to in this country are all paid by rich people. Billionaires pay no taxes, and they do it using this simple scheme. Billionaires buy and hold on to assets of real value. They have to pay taxes when they buy, by the way, but that's beside the point. They buy the things, they hold on to real value, they borrow against the real value, the asset class, and then they spend the debt money, the money that they have borrowed that is accumulating interest interest in debt, and then they just die and that interest in debt goes away. Is there any relevance to this tax scheme?
First of all, I don't even know where this comes from. This is a recent phenomenon where the leftist Democrats in the United States Congress came up with this buy, borrow, die fallacy. And there's no question that people buy assets and borrow against the assets. Middle income Americans do it all the time. Ever hear of a home equity line of credit? People do this all the time with assets that have equity in them. They borrow against the assets. The thing is this: when you buy an asset, whether it's an individual asset like your home or a business asset like an office building, or a rich guy buys a home, let's say he buys a $50 million home. People buy these assets with after-tax income. All right, you have to earn the money first, pay the tax on the money. When you get it, then you can invest the money in assets to produce other income. So right away, we've got an asset that's acquired only as a result of earning income that you paid taxes on in the first place. All right, so that's number one. Now, when you get a loan on an asset, whether it's a $100 loan on a credit card or a $100 million loan to buy an office building, you have to pay back the loan. Number one is you got to pay back the loan, and there's interest on the loan. Now, when you pay back a loan, Josh, it's paid back in two parts: principal and interest. The interest is a tax deduction only if it's business spending. So what Wyden says here is that these billionaires borrow the money and use that money to enhance their lifestyle. Let's say they borrow against the asset and use the money to enhance their lifestyle. In that case, the interest on the loan is not deductible, because personal interest used to finance your lifestyle is not deductible. They're not getting a tax break on that. If it's used for business, business interest is always a tax deduction. And it's never been a situation where the United States government tried to tax businesses on gross receipts and not net business income. The interest used to fund operating expenses for a business or to buy capital assets for a business has always been tax deductible. There's simply no question about that. All right, here's the other thing. What if you don't pay the loan back? If you don't pay the loan back, there's a tax liability that kicks in on forgiveness of debt. If they don't pay the debt, there can be an income tax liability. Now, here's the other thing. The principal on the loan is never tax deductible. And that's true whether you buy a car for business, a building for business. It makes no difference. The principal is not tax deductible. And so Wyden is just so twisted in his thinking on this, and he's reaching so far into the fantasy world to make a case for this tax that it really is beyond the pale.
They tax you for your income, and then they tax you on the purchases that you make. And then once you actually have made up a little bit of money on top of that, they tax you on the money that you have. So what haven't they taxed you? Are there any elements of life that they haven't touched with their taxes at this point?
Nothing that I can think of. They don't tax the air yet that I know of. They tax your water.
Yes, they do. It's called a carbon tax.
A carbon tax is a tax on energy, not a tax on air. So I'm talking about the air you breathe right now is not taxed.
It's a tax.
So now here's the other thing. Really what they're doing with this thing is they're making a sort of wealth tax. All right. He's calling it an income tax, but the fact of the matter is it's actually a wealth tax. And the reason it's a wealth tax is he wants to apply what are called mark-to-market accounting techniques to assets that are held personally by these high-income people, the high net worth people. And what that means is that under a mark-to-market system, well, let's talk about the way it happens right now. The way it happens right now is if you buy an asset for $1,000 and the asset accumulates value to $3,000, you don't pay tax on the appreciated value until you sell the asset, right? So if you sit on that asset and it acquires value of an additional $2,000, $3,000, $4,000, as long as you don't sell that asset, you don't realize that profit. It's unrealized gain. You realize the gain when you sell the asset, and now you have to report the purchase price, the sale price, and you pay tax on the difference. So if the purchase price was $1,000 and you sold it for $3,000, you've got $2,000 capital gain on that asset, and that's what you pay the tax on your capital gain. The income gets reported in the year the property is sold, which is the year the gain is realized. What they want to do is they want to force these people to mark the value of their assets every year to the fair market value of the asset at the end of the year. So let's say you buy an asset for $1,000 in January, and on December 31st, that asset is now worth $3,000, but you don't sell it. Under current law, there would be no tax liability because you haven't realized the gain. If we are forced to mark that asset to the market, that is to say, bring up its value to current fair market value as of the end of the year, then that person would have tax on $2,000 of capital gain that he never realized. This is what I call phantom income. Wyden wants these people to pay tax on phantom income, income that is not actually realized, but is only paper profits that don't mean anything because the asset's not sold. And so this was what Elizabeth Warren and Bernie Sanders wanted to do.
This is the same thing that Kamala was talking about with the unrealized gains tax. My question is how anyone who understands markets, they must not understand markets. That's the only thing that I can come up with, because if you understand a market, then you know that forcing someone to value their property at a certain amount and then taxing them on a phantom income, that is all that's going to do is force them to actually then sell that asset in order to pay the tax. Otherwise, how are they going to pay the tax? There's no money to pay the tax until you sell the thing.
The theory is that the billionaire has the money sitting in his safe deposit box or in his home safe someplace.
They have some Scrooge McDuckian image of billionaires with a silo full of gold coins that they go diving into without realizing that no billionaire hoards cash like that. That's the reason why they're billionaires.
They have cash, but they don't hoard cash. You're exactly right. The cash is generally invested in income producing assets. This idea that they're just hoarding the money, that money's not in the marketplace and it's not working, and it's just simply not true. Billionaires are billionaires because they're producing income, right? And when they're producing income because they're likely providing jobs for people in the production of goods and services. Everybody benefits from the production that these people are responsible for. You just take Bill Gates for an example. I don't care what you say about Bill Gates's politics and theology. The fact of the matter is that he is responsible for the tremendous level of wealth creation in this country in the 40 or 50 years that Microsoft has been around, 30 years, however it's been along. I don't know when it got started. Middle 1980s. Call it a year.
You're going on 50 years there.
All right, so we're going on. All right, the point is that he has made the lives of tens of millions of people better. He has increased the wealth of tens of millions of people exponentially, no question about that. There are people in his own company that have made millions and millions of dollars. Investors have made millions and millions of dollars off of Microsoft stock. This is what producers do. They create wealth. And what Wyden wants to do with this system is he wants to destroy wealth. Here's what's crazy about this. He talks about all the hundreds of billions of dollars that this system would raise, that this new tax would raise, and he says in his summary here that this money is going to be available to shore up funding. He says we're going to shore up funding in all these other areas, and places like Social Security and Medicare are going to have all this additional funding. Let's put this in perspective here. Even if he's right about it raising hundreds of millions of dollars, which he can't be right about, but let's just say he is, and let's just say those hundreds of millions of dollars are $500 million a year. Now, I haven't seen a Congressional Budget Office score on this bill yet. There probably isn't one because it just got introduced a week ago. So there's no Congressional Budget Office scoring. But forget that for a second. Let's just say it's going to raise $500 billion a year. The 2024 operating budget deficit for the federal government, Josh, was $1.8 trillion.
It's a drop in the bucket for the amount of money that these people are spending on a regular basis. And they think that just taking more money, that they're going to be able to solve the problem. They have to spend less money.
They can't wrap their heads around that. The fallacy is that even if this bill is passed and the tax increases are wildly successful, it's not enough money to balance the budget, to solve the operating budget deficit for just 1 year. Never mind the long-term effect on increasing federal revenue. It's not even going to come close to balancing the budget. So if it's not even going to come close to balancing the budget, tell me how this revenue is going to shore up funding for these other programs. It's not going to. Now listen to this, because taxes create distortions in the marketplace. A distortion is something that causes somebody to do something they otherwise wouldn't do, or stops people from doing something they otherwise would do. Income taxes, by the way, create the most distortions in the marketplace. So when you tax high wealth like this, you discourage production. What you tax, you get less of. When you put additional tax burdens on high-income people if they earn money over here, guess what? They have the choice to not earn income over here or earn income over there. They can adjust their activities to avoid the tax in that area. But that always means decreased production, which means decreased productivity, which means decreased real wages, which means decreased income for the people that are working at those firefighters and those secretaries that Wyden is pretending to care about, which of course he doesn't care about those people people at all. What Wyden wants to do is transfer wealth. This is what these Marxist income tax plans are all about, transferring wealth from the producers to the state.
He's trying to get more money, and I would say it's even more insidious than just wanting to get more money. What it really does is it puts another tax on the book that is specifically targeted at a small group of people that they can widen the scope over and over again, like they did with the original income tax. That's been their playbook from day one.
Yeah, that's exactly right. And that's why these things are so insidious. Once they get the camel's nose in the tent, you can't keep the animal out, because next year that goes by, year after that, they widen the net. And before you know it, every American citizen is paying tax on phantom wealth income as calculated by Wyden's team of economic witchcraft.
That is why we need to tell our senators, our local and federal representatives, that it is time to get rid of the income tax entirely. And that should be about all for today. Taxpayers, thanks for watching. Dan, tell them where else they can follow along with your Taxpayers' Rights Crusade.
Yeah, you can follow me. I'm at Pillow Talks Taxes. I'm primarily on TikTok, Facebook, True Social, and YouTube. Make sure you like, share, and subscribe to the channel, and share these videos with your federal and state representatives. If you have a tax problem, go to my website, TaxHelpOnline, and buy any book off my website at any price point. It doesn't matter how much it is. TaxHelpOnline.com. You buy any book off that website, you get a free 15-minute consultation directly with me.